This pessimism really felt in what is being reported in the news, right? Because this GTV chart on the Bloomberg just showing the mention of the word stagflation just skyrocketing in the past few weeks. How important is it to have this quality bias in your portfolio, and how would you achieve that?
I do think quality bias is important at this point, especially when market volatility is on the rise. I think the other point to bear in mind is that as the economy continues to progress, we're moving from the mid-cycle, arguably to a late cycle for the rest of this year. And I think the growth concerns is still going to be on top of investors' minds. So I think how you achieve that, you're looking for companies with operational leverage where they can manage costs more effectively, or they've got more pricing power and they're able to pass on those costs to their customers. So I think, it is an environment where active management becomes really important to pick out those companies. And also, we have seen companies with little or no profit being penalized as well. So I think it's pretty clear to me that investors are looking for companies who can deliver reliable, consistent earnings to shareholders.
Can you find some of those companies in China at a time when you're hearing, even from Premier Li Keqiang, that the economy in some ways may be doing worse than during the height of the pandemic?
I think so. If you take a slightly longer term view, for example, 6 to 12 months, I still think that the Chinese economy should slowly improve in the second half of the year, partly due to, you're starting to see the new infection numbers coming down, but also we are expecting more robust policy stimulus coming through. Now, obviously, again, this comes back to what sector we're looking at, where we have seen some sectors, for example, consumer staples, even the financials, being more consistent in terms of delivering earnings. I think that, again, will be the focus of investors, whereas some of the high growth sectors that we've seen more volatilities, whether it's regulatory related or whether it's macro cycle related, I think those will be somewhat more scrutinized by investors.
Internationally, you still prefer the US over Europe, and you're willing to take that duration risk. When it comes to the Fed pause and this kind of perceived repricing we're seeing, does that give some space for a meaningful rebound?
I think for the US, I do think so. I think if you look at what's pricing in or being priced in the markets right now, it's very much a much weaker growth environment, which is perhaps more of a perception rather than a reality. I know the market's trying to front run the investors trying to front run the market or the economy by several months. But if you look at some of the leading indicators or ISM manufacturing indices, I think the US economy is still in expansion mode. Earnings, although obviously slower compared to 2021, it's still consistently growing. So I think from that perspective, I still think that the market's probably a bit too pessimistic. In terms of fixed income, after a really, really tough 6 to 12 months, I do think we're starting to see some value being restored in the fixed income world. And therefore, I do think that investors can revisit this space, especially for those who do want to generate income. And for example, investment grade corporate debt, I do believe does provide a better balance between being resilient in a slower growth environment, but at the same time, delivering income and yields to investors.
Are there opportunities in Chinese credit in that space that you're willing to look at right now?
I will still be very careful with the high yield, especially in the real estate space. I think there are still going to be some pain coming through. But if you look at the better quality names, including Chinese government bonds, I do think that you are in a policy easing environment in China. And at the same time, while obviously economic growth is challenging, many of the better quality names, I think they're still in reasonably good shape. So I would definitely include Chinese fixed income as part of the portfolio, but also bearing in mind that if we are in a still Fed tightening mode, we do want some diversification. And I think China's fixed income does play a role in that.